OG Macro AG here. We need to start with the numbers, because without emotion, without narratives, the numbers already tell the story. Paper silver collapsed roughly 40% from the recent highs. At the same time, reported physical silver demand surged over 250% across multiple regions. Those two facts should not coexist in a healthy market. Yet here we are. This is not about predictions. It's not about calling bottoms or tops. It's about understanding stress, liquidity, and structural fractures inside the global metals market. What we're seeing right now is not normal price discovery. It's a system under pressure. Pause. Let's walk through it carefully. Silver didn't drift lower. It didn't roll over gradually. It collapsed. From peak to trough, paper silver futures lost close to 40%, compressing weeks of downside into days. That kind of move does not happen because of retail sentiment. It does not happen because demand disappears overnight. It happens because leverage breaks. Margin calls force liquidation. Liquidity vanishes. Positions are closed not by choice, but by necessity. And when that happens, price becomes a liquidity signal, not a value signal. Gold declined as well, but far less aggressively. That divergence matters. Because silver is not just a metal, it's a hybrid, monetary industrial, and heavily leveraged in paper markets. When stress hits, silver absorbs it first. After the collapse, we saw a bounce, not a recovery. A bounce. This matters. The bounce was driven by short covering mechanical rebalancing volatility compression after forced selling not renewed confidence. Volume declined into the bounce. Open interest did not meaningfully rebuild. That tells us this was relief, not accumulation. Markets breathe after shock. That doesn't mean the damage is undone. From a structural standpoint, silver sliced through medium-term support, long-term moving averages, and prior consolidation ranges. These weren't levels traders like. These were risk management thresholds for funds. Once breached, liquidation became automatic. The bounce stalled below former support, now resistance. That's textbook. Not bullish, not bearish, just mechanical. This is the core issue. Paper silver is traded with extreme leverage. Futures options. Synthetic exposure, ETF structures dependent on authorized participants. When volatility spikes, margins rise, funding costs jump, risk desks reduce exposure, silver becomes collateral damage. This is not about silver itself. It's about dollar liquidity. And right now, dollar liquidity is unstable. Now here's where things stop making sense, unless you understand structure. While paper silver collapsed, physical premiums rose, inventory drawdowns accelerated, retail and wholesale demand surged. Reported physical demand up 250% is not noise. That's stress behavior. It tells us buyers are not price sensitive. Availability matters more than spot price. Trust in paper settlement is weakening. Paper price says oversupply. Physical market says scarcity. Both cannot be true. Look at vault movements. COMEX registered inventories trending lower. Eligible metal not converting, withdrawals exceeding deposits in key weeks. LBMA transparency remains limited, but delivery times are extending. That matters. Because physical markets don't respond to futures charts, they respond to availability. And availability is tightening. Asia is the tell. Shanghai premiums have remained elevated relative to Western paper prices. That's not speculation. That's physical demand expressing itself. When Eastern premiums rise during Western price collapses, it signals geographic stress in supply chains. Metal flows east, paper contracts stay west. This divergence has appeared before, and it has never resolved smoothly. The gold-silver ratio expanded sharply. That tells us two things. Silver was used as liquidity. Gold retained monetary demand. Mining ratios do not justify current pricing. Inventory ratios do not justify it either. This is not equilibrium. It's distortion under stress. We can't isolate silver. Equities experienced volatility expansion, risk-off rotations, correlation spikes. Crypto saw forced selling. Stablecoin stress, liquidity drains. These are not separate events. They're connected through leverage and funding markets. Silver was simply the pressure valve zoom out. Global debt levels remain extreme. Policy guidance remains uncertain. Central banks are constrained. The Fed cannot easily ease without reigniting inflation risk. It cannot tighten without breaking liquidity. That indecision is destabilizing. Markets sense it. Let's talk probabilities, not predictions. Bearish continuation scenario. Further deleveraging, continued paper selling, physical premiums stay high, but price weakens, bullish structural scenario. Liquidity stabilizes, physical demand forces inventory repricing. Paper price re-anchors to availability, neither is guaranteed, both are plausible. Not opinions, data. Watch. COMEX registered inventory changes, Shanghai premium spreads, lease rates, delivery delays, open interest versus price behavior. That's where truth shows up. Silver did not collapse because demand vanished. It collapsed because leverage broke. Physical demand exploding during a paper crash is not bullish hype. It's a warning signal. This market is stressed, distorted, and fragile. Stay analytical, stay patient. Respect risk. Sign off. Stay sharp. Watch the data. Think independently. OG, Macro, AG out.